right, let's welcome in senior markets correspondent George Tsilis to take a look at some of the biggest movers this morning. George, welcome. And I think a good place to start is with Atlassian, ticker symbol TEAM, because it's a huge earnings winner. Shares up about 18% following the report last night. Fill us in. What is it that Wall Street likes?
Well, obviously, it was a really good report. If you look at the business itself, I mean, this is a workflow productivity company, collaborations tool business, and of course, also they provide things like IT desktop solutions. So this is a business that could be well suited for AI, and they did demonstrate growth in that area of their business. But just looking at the print for EPS and sales, the company posted 96 cents, beating the estimates by 20 cents. So that was about a 31% gain compared to last year. And if you look at the revenues, they came in ahead of estimates by about $100 million, increased by about 22% at $1.29 billion. So you saw sales higher by 21%, earnings higher by 31%. And at the same time, if you look at the breakdown and how they manifested those sales and earnings, first, I mean, they're near the 5 billion mark in terms of the run rate in sales. The other thing is the subscription revenue grew 30% year over year, with AI interactions increasing more than 25-fold over the last year as well. They also denoted 40% year over year growth in premium edition. So large enterprise growth, premium edition growth, and subscription revenue growth. All these numbers on a rate of change basis were higher than total top line sales. And so that is giving you an idea that the cash flow position, the operating margins for the business continue to expand. And as a result, we're seeing a nice movement to the upside.
Yeah, but here's the thing. A good earnings report doesn't always mean that you see green arrows, and we're seeing that as the case with Deckers right now, and shares off 13.5%. And I think the thing with that is, I know last night when we were going through the report, we were having a tough time finding what investors didn't like, because in after hours we were seeing these losses that are coming to fruition today. So I don't know if you had some more time to look through it. Tell us, what is it that has investors so downbeat about Deckers, which was a favorite up until today?
Sure. Yeah, so you're right. I mean, this is the conundrum. If you look on the surface, just looking at the EPS, $3 a share, beating the estimates, which were $2.55. That EPS growth is about 19% year over year. If you look at the top line sales, $1.83 billion, they were also higher, beating the estimates, and those were higher by 17%. And the breakdown, of course, Uggs and Hoka are two very popular brands. The stock has performed exceptionally well over the last year as a result. Uggs grew 16%. They also denoted that their rewards program for Uggs grew 25%, Hoka 24% higher. But the kicker, I think, is the revenue growth outlook. The revenue growth outlook was in line at $4.9 billion, so it wasn't a beat. While at the same time, the expectations for revenue growth are around 15%. So that's lower than the rate of change we saw for the quarter. But nonetheless, the other issue, which I think is creating some problems for shareholders today, is the anticipated growth in Uggs brand at 10% for the fiscal year. And Hoka is flat on a year-over-year basis compared to the growth we saw last quarter at 24%. So they grow 24%, Hoka's brand for the quarter. They're expecting 24%, which is essentially equivalent rate of change in fiscal year 25. But their Uggs brand, even though double digits, 10% is still pretty remarkable growth. It wasn't the same level of growth that we saw for the quarter, and I think that's the reason why they're selling it off.
Yeah, so really basically up against some tough comps. The longer you do better, the harder it is to beat.
That's it.
But still, double-digit revenue growth for a shoe company at a time when consumers are allegedly, more price conscious and pulling back still seems impressive. So do we think that this was just a case of Deckers being priced to perfection and now getting punished? Because I'm seeing some price target cuts as well.
Yes. Yeah, that's the thing. It really comes down to expectations, price for perfection, and then those growth expectations not inching higher. And so, again, not a bad brand, not a bad report. It just comes down to a recalibration of expectations. And so this is a give back quarter, and we're seeing some sell off as a result.
Okay, yeah, down 13.5% right now. Now officially negative for 2025, down about 11% in 2025. Still up over 50% over the past 1 year. So we'll certainly keep this one on our radar as well. All right, next up, Vertex Pharmaceuticals. Share is up about 4.5% after an FDA approval. Fill us in on this, George.
Yeah, so this one's an interesting play if you're looking for, biotech companies that deal with rare diseases. Cystic fibrosis is Vertex's mainstay drugs. They also have drugs in the pipeline for oncology, but at the same time, they're dealing with what is a big problem in our country, which is opioid addiction, opioid use to deal with pain relief. So essentially, there was some positive news today that Vertex received FDA approval for a first of its kind non-opioid pain relief. There's a lot of also device makers like Medtronic that are actually moving in the direction of nerve blocking, agents that again help with pain relief. So I think this is a trend that's going on for dealing with opioid addiction, but at the same time, it serves as a catalyst for Vertex getting the first of its kind approval for this non-opioid type of pain relief.
Yeah, it looks like it's going to be sold under the brand name Journavax, and certainly giving a nice boost to Vertex shares right now, up more than 4%. All right, finally, you have your eyes on Walgreens. Shares down 15% after the company said it's suspending its dividend. Wall Street clearly not happy about that move. What did the company have to say about it?
Well, I mean, this has been a long story. You look at Walgreens, first off, in the last year, it's down 50%, 3 years down 83%. Extremely disappointing stock from an investment standpoint. Not surprised to see the sell-off, despite the fact that cutting the dividend, which is about $1 per share per annum, essentially means that, institutional investors who maybe have a charter, a pension fund that has a charter that says they can only own dividend-paying stocks has to actually sell the stock. So we're seeing some pressure of Walgreens, which has been, closing stores, shoring up its balance sheet, and now cutting its dividend to bring in more cash to potentially service the debt, which is about $32 billion on the balance sheet. So Walgreens has been going through a transition, store closures, competition from online e-commerce pharmacy companies, even brick and mortar companies like Costco have been very good at competing on price with Walgreens. So ideally, this should, in the long run, help the business shore up the balance sheet by suspending the dividend. But at the same time, this is a business that is still closing unprofitable stores and is reforming itself. So, sell-off today really is reflective of the fact that institutions that have to own dividend-paying stocks can no longer do so.
Yeah, and I think that for a name like Walgreens, given all of the headwinds that you mentioned, dividend, the fact that it was a dividend payer probably was a selling point for it. So just in terms of if history is a guide, should we expect to maybe continue to see declines for a name that's up against so much?
Well, the whole company is up against a big challenge. So what we're actually seeing for the business is a restructuring of operations, and that includes real estate. Just looking at what the company printed last year, just in context, the company lost around $8.5 billion on quite a large sales base of $150 billion. So it's a very large company, which was formerly a Dow component. But ideally speaking, they're losing money, and so they're shoring up the balance sheet and sort of giving a indication to Wall Street that they're dealing with the debt load, which is still quite large at $31 billion compared to the equity now, which is actually quite low at around $9 billion. So the debt is about 3 times the equity, which is quite high. But this is a turnaround story, which is going to take some time.
All right, so no longer on the Dow, but the worst performer on the S&P 500 today. Interestingly enough, still up, despite this 15% loss today, still up about 4% in January. So actually has been a pretty big winner in 2025, but almost 60% away from the 52-week highs. All right, George Tsilis, appreciate you breaking all the movers down for us. Thanks so much. We'll see you later in the show.